Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone. Welcome to another edition of Accredited Investor Markets Radio. I am your host, Christopher Cahill. This is episode 11. You may remember, those of you who are Bruce Springsteen fans, that he made a big splash with the album Wrecking Ball in 2012, supported by a very big concert schedule. And the album and the concerts were very much in the spirit of Occupy Wall Street. He railed against the evil of the 1% and of various corporate malefactors in big anything. Of course, not lost on some listeners is that this was a billionaire singing before audiences with many a senior manager in it having paid $100 a ticket. Not that I begrudge Bruce. He may be the richest man I've ever seen, but I don't mind him stacking his chips. One might wonder, if one looks back in time, whether he was purging himself of the stain of 2009, at which point he contracted with Walmart, famously, for exclusive rights to sell his 12-song compilation at $10 each. His fans, many of his fans, were quite outraged that he would do such a big deal with Walmart when Walmart was known to have labor issues, to put it mildly. Bruce assured his outraged fans that, quote, we, end quote, were doing a lot of things at once and inadvertently did business with Walmart. Well, all of this came to mind when I read a recent article, September 24th, New York Times piece, entitled Walmart Prepares to Offer Low-Cost Checking Accounts. The piece was written by Hiroko Tabuchi and Jessica Silver Greenberg. So Walmart entering the banking business. Well, their intent is to supply checking accounts to almost anyone over 18 who passes an ID check, with no fees for overdrafts or bounce checks, no minimum account balance. Well, that sounds pretty good. The accounts will cost $8.95 a month if the direct deposits that are put in it are less than $500 a month. Presumably, I think they're free if you have direct deposits of greater than that amount. GoBank is how the service will be called as part of Walmart's push into financial services for people with little or no access to traditional banking. Now, to every action, there is a reaction. The following day, an article appeared in The Hill, and the article is entitled, Banks Fret Over Walmart's Foray into Checking. And I'll just quote what the article quotes from the president and CEO of the Independent Community Bankers of America. Quote, quote, these accounts should be subject to the same legal and regulatory framework, consumer protections, and oversight as traditional checking accounts offered by banks. Well, okay, this arouses in me the three following observations. Walmart can provide checking? Well, consider that for a minute. There must be banking outside of Citi, JPM, B of A, and Wells Fargo, which is to say, these entities are too big to fail and must be saved, according to some people, by public funds if necessary. Well, let us consider that where the need is present, other entities, non-banks, will be happy to provide, in this case, checking accounts, or in the case of PayPal and Apple, online payment systems. The second observation is that The Hill article quotes a small bank organization brandishing regulatory apparatuses to counter Walmart's attempt to provide better and cheaper services. Usually, small banks are criticizing the regulatory apparatus for favoring large banks, which, after all, can gain influence over the regulatory apparatus and more easily absorb the costs of compliance. And in connection with that, I would like to mention a ProPublica article at www.propublica.org, dated September 26 by Jake Bernstein, entitled Inside the New York Fed, Secret Recordings, and a Culture Clash. It's a long piece which has a lot of detail about secret recordings made within the New York Fed, which demonstrate that the New York Fed is certainly influenced by the entities it regulates. In this case, Goldman Sachs. There was all kinds of deference extended to Goldman Sachs. The third observation I'd like to make is that in connection with checking accounts, Walmart ends up being for the little guy, after all. Well, maybe Bruce doesn't have that much to apologize for getting in bed with Walmart in 2009. Well, let us move on to the interview because, as we say at Accredited Investor Markets Radio, tramps like us, baby, we were born to invest. Hello, this is Christopher Cahill, and I have with me today David Drake. David Drake is a leading equity expert based in New York City. He is the founder and chairman of LDJ Capital, a private equity advisory firm, and of the Soho Loft, an event-driven global financial media company. Mr. Drake is a strong advocate of innovative investing in early-stage equity and of the United States recent Jobs Act, for which he lobbied both in Congress and before the EU Commission. Because of his work in this space, Mr. Drake was named a U.S. Commerce delegate to the EU Commission in Brussels and Rome and was invited in May 2013 to the White House Champions of Change ceremony in Washington, D.C. Now, the Soho Loft produces and sponsors over 150 global events each year. One such event in April 2013 was for the institutional media leader Thomson Reuters, with speakers from NASDAQ, the New York Stock Exchange, KKR, and the Carlyle Group. David continues to advance innovative testing through his work as an international speaker and regular writer for major publications like Forbes and Thomson Reuters. Mr. Drake co-authored the book Planet Entrepreneur, the World Entrepreneurship Forum's Guide to Business Success Around the World, and Mr. Drake wrote Crowdfund Economics, another book. And 2 days ago in Forbes magazine, a substantial article by Mr. Drake appeared about family offices, which happens to be our subject matter today. Mr. Drake, for our listeners, what is a family office? And if you wouldn't mind speaking for a while on the history of the family office's investment role.
Thank you for having me on for today. It's a pleasure being able to join your radio show. As I've looked at family offices, and my definition has always been wealthy families and individuals. They're organizing their own lifestyle as well as their own investments with in-house counsel and in-house staff that will take care of their jets, their homes, their bills, and their own investments in their own corporations. And they will be most likely outside of using bankers because they're large enough to hire their own staff. Now, a lot of people argue that, the epitome of a family office was created by Mr. Rockefeller in the Rockefeller Center in the mid-90s, made his millions and billions in oil and gas. And I would argue that the family office has started with the Medici family out of Florence.
I'm sorry to interrupt you, but I'm so glad you said that because I began thinking, didn't the family office start with the Medicis?
Exactly.
Please go on.
And I admired what they did. And, interestingly enough, they would be known for poisoning their enemies versus Borgias that would stab their enemies. Yes. I'm sure people watch different shows on TV, but the Medicis also fascinated me because not only became the strongest financial bank institution in Europe, they also backed and supported the arts. And we're not talking about just any kind of artist and painter. We're talking about Da Vinci himself. We're talking about Michelangelo himself and Galileo himself. So it was a powerful family. That last lineage of the family name allegedly passed away in the early 17th century, 1712, I believe. But I'm writing a novel and doing some research to see if that actually was the case. Who knows? Maybe they went underground, like we've seen in the Da Vinci Code, where the Templars are hiding secrets of the past. Well, I wanted to bring it to the future of today, and
yes.
The interesting part is certain countries and certain cultures are not familiar with the family office concept, where it's being run as a corporation on the professional side with budgets and allocations and diversification. And, and I'm referencing right now Asia and specifically China. Today, China has 4,000 individuals with $100 million net worth that would qualify to be a family office, but they are not accustomed to the concept of family offices, and they're not operating as a family office per se. And even in the U.S., a lot of groups are large enough to be family offices, but they manage their assets independently and individually, and their, large bank trust and bankers are still supporting their investments. So it's a gray area, and furthermore, it's difficult to penetrate the family office world, which, one of the reasons is, well, they're made a lot of wealth for themselves, and I consider their family office somebody who has at least $25 million in net worth and above. And then that goes up to billions, of course, and some of the larger ones won't even be on the list because they diversify the holdings and interest not to even be on the list. So sometimes it could be difficult to identify a family office if they're not being exposed to family office networks and publications that we have of today. So it's always been a very fascinating world, even more so that families lose their wealth by the third generation. And it's amazing, 85% of family office wealth is ruined and destitute by the third generation of ownership. And that's just tremendously high. We all know the Vanderbilt family. Well, by 1915-17, towards the end of that decade, their third generation was destitute, and the family didn't have any money anymore. But the name lives on. So it's a fascinating world, and the more careful family offices, which are the older ones, have been around for a while, they are, like I consider the Swiss. They take care of their wealth, and they're careful. I was just having a conversation with a friend of mine who used to work for one of the biggest billionaires in Russia. And the firm was actually partners in TNK BP. BP became TNK Oil Corporation's partner in Russia, creating the biggest oil company in Russia. And that family office, faced the same thing. They built up their wealth, and over time built their wealth up to several dozens of billions of dollars. And my friend and I were talking about how he was the first person in private equity that the gentleman ever hired. The allocation for family office and private equity, and specifically hiring people that are professionals in private equity, is very low. That's one of the challenges we've been looking at.
What you were saying, you were talking about the third generation, and one can imagine certain dynamics that might cause that. But in my work as an insolvency attorney, I see it happening sometimes in the first generation. That is, hundreds of millions of dollars are made by somebody who had a vision and who was great at executing that vision, built up a great wealth in a sector. Maybe the sector is now experiencing challenges because of technological change or something, or maybe something else. But you have the founder, and that founder knows how he built his wealth and may be quite reluctant to A, embrace a family office, and B, take its advice. Is that a dynamic you have seen?
Oh, absolutely. We see that all the time. People make wealth, and then they lose it quickly. A crisis, misconception of what's happening, liability, regulatory changes, competition. We see that all the time, but I don't count them as family offices and not operating as family offices. Those are family-run businesses, but not a family office per se, who have diversified their risk and have income and investments and resources across the board.
Diversifying risk. I just read about a famous person, I won't give his name, who made, 40 or 50 million. So at the lower end of this range we're talking about, but nevertheless, his money manager put a great deal of it into the Madoff funds. And so his net worth will be shaved down substantially. So diversification seems to me to be something a family office can really help with first-generation wealth creators.
And the way I look with the family office compared to the gentleman you're referring to is they'll have their own managers building a portfolio of investments, limited partnerships in hedge funds and private equity funds, in real estate funds, operating businesses, as well as public stock and bonds, the portfolio that they manage in-house, as opposed to using bankers or allocating too much of money into just matters in that essence. But also taking care of the personal travel and the personal homes and the personal yachts and the personal lives. And it all happens inside, one building per se, almost. And in that essence, that's what we consider a family office, who's run internally and understands the diversification risk and understands that they have to have the matching different assets. And interestingly enough, private equity is one of the areas that I see the least involvement for the family offices, because unless they understand the industry, which is most likely the one they built themselves, and the second and third generation is the second challenge, which is succession rights. The kids don't want to be in the same business. They're often spoiled. I mean, we've heard about the billionaires saying, hey, I'm not giving my kids a cent. I don't care how many billions I have. They got to make it by themselves, because I don't think they'll appreciate it otherwise. And we've seen those news stories over the last couple of years where billionaires are making those claims. But in your scenario, yes, I see it all the time at our conferences and people we talk to. They make millions, hundreds of millions, and they lose it equally as quick.
Let's return to the private equity role a family office might play, which you were actually touching on, but I'd like to return to it a little later. And maybe you've already answered this in some ways, but what are the keys to a family office success? What are the keys, if there are any, if you know of any examples, to a family office failure or not such a great success? And what should a family fund look for in a family office?
Well, the failures we've seen over the years in family offices is that they don't have a budget or a profit and loss statement of their own assets. And they'll overextend themselves really quickly by buying a yacht or a jet just because they believe they can, but the numbers don't add up. And suddenly they are on the brink of ruin. And so the success of a family office is not only to be able to have a profit and loss, but also a diversified portfolio and a budget. And understand that if they're going to make an investment, they might have to diversify and maybe sell other investments to compensate for it and allocate assets in their wealth in different areas. And that's part of keeping a good balanced operation for a company, a family office specifically. And a lot of them first generation started a business that, later on the second generation, which becomes the biggest issue, they don't want to run it. They don't want to be in the family business. And it's probably one of the biggest challenges that family offices have. We see a lot of family offices that run large $100, $200, $300, $400 million companies, and there's nobody to take the reins. Nobody in the family wants it to take the reins. So now they have to look at, well, what do we do? Do we sell it? Do we go IPO if it's possible? Do we diversify? I mean, look at the Hiltons. I mean, Hilton sold to Blackstone their whole portfolio in 2007. I was just at Ron Hilton's wedding 6 months ago in Beverly Hills, and there's 6 or 7 brothers in the family, and they sold their hotel chain. Now, of course, they got tremendous wealth still after that, but that was a situation where, the family office of theirs made a decision that that's what they needed to do, and they did it right before the crisis, which, in my terms, looks very clever.
And you think that may be a function of generational change in the management desires of second or third generations in the Hilton case?
And we see that over history that families get so large that they need to split up the assets and go separate ways.
Yes.
The Rockefellers have 20 to 30 different Rockefeller groups. The Hilton have, 7 siblings that now have their own assets. And that's what happens. The Waltons in Texas have also tremendous wealth in different family directions. And it's just, it's just the evolution of family offices that it becomes diversified, and people go their own direction for the ones who are successful to keep their wealth. So they have to divest their holdings.
Might it be a good idea at that point to divest the family offices? Or is it better to have the various affiliated, literally affiliated, parts of the family tree of companies kind of centrally managed?
Well, the multifamily offices allows that to happen and allows to manage several family offices at the same time. But, I look at the Empire State Building that went IPO in October 2013. And a dear friend of mine, a family office per se, but it doesn't act as a family office necessarily, owns 10% of the building. Then now there's 2,800 shareholders, and the biggest shareholder, Hemsley Spear, kind of forced the sale of that property and the whole category of properties underlying that asset. And that's why they went IPO, and now you got 2,800 shareholders who actually have a holding period of 1 year. And in October, towards the end of October, they will be able to liquefy and start selling their shares on the stock exchange. Right now, I remember it was trading at $17, but the float was only 60,000 shares. So if you want to buy 1 million shares, you wouldn't be able to until these 2,800 shareholders will be able to enter the market, which is going to happen shortly. But then at the same time, there are shareholders who will sell privately secondary shares, just like we saw Facebook do, just like we see Alibaba doing right now. And the secondary market is very attractive because people are bullish on that stock going public. So there's another scenario where an asset had to be sold because of the Hemsley Spear inheritance.
Actually, your comments about multi-portion family funds, and the need for centralized direction from a family office made me think about all the times I've been involved in or noticed or actually had to litigate on behalf of siblings or different generations suing one another. Obviously, families that gain wealth, there's something greater to fight over than the things families normally fight over. Is that something family offices try to keep an eye on? That is, suppressing the chances or avoiding the chances for internecine battles?
Oh, it is in the core of all family office trouble. And the smartest family office operators, the hired guns, understand that. And they understand how to nullify and rectify and reduce the conflicts. So you're absolutely right. You would be a valuable asset to create a multifamily office. Maybe you and I should be talking about that separately. Because we have a lot of groups out there, and they need to have, they're not large enough to service everything they need to do. So the multifamily offices, they will manage several offices' interests and diversify the cost across board of several different groups. So it gets similar to wealth management, asset management, but family offices, multifamily offices are operating on the premises that are also taking care of other interests.
Yes.
But you're absolutely right. You should be getting into this business, hopefully with us, to start talking to some of these groups because, well, it'll bring you more business, but also they'll reduce stress and conflict that you've seen happening left and right. But it is also happening with the family offices. The kids are fighting all the time, and you obviously are at the forefront before they become a family office, whether you see them fighting.
Yes. Well, it's
indeed
destructive of the people, but destructive of wealth as well, and the opportunity to use that wealth to grow other wealth for themselves and for others.
Yeah, and that's why these big family offices like Rockefellers and the Waltons, there are dozens of shots, DuPonts as well. They just managed to retain their wealth and their businesses for decades and, centuries, and families go in different directions. I'll give you an example. Abu Dhabi Investment Authority, I've been working with them, the largest pension fund in the world. I've been going out there 4 times a year, working with them, making investments. Some of the ruling family there decided, well, we wanted to do things a little differently, so they created Abu Dhabi Investment Council, an offshoot that started with $2 billion in 2006, 2007, operating, like a mini sovereign wealth fund. Mm-hmm. So, you see that happening all over the world. And the trick is not to be taking too many risks. The conversation I had with the private equity employee of a billionaire family was that, hey, family offices don't hire private equity professionals. And they don't do that much private equity mainly because they might know one or two or three businesses they've been in, but it's really difficult to build a relationship with them to start investing in different asset class in private equity. Consequently, private equity shops are the experts in the field. So he was asking me, can you find me a family office who will hire me as a private equity expert, allowing me to go in and do M&A opportunities in different industries, from media to real estate. So there are opportunities in this space, and it's a very peculiar world where they want to remain very private, and they kind of like to interact with themselves, with other groups, understand the privacy, understand the lifestyle, and understand the challenges. And maybe back to your first question, what makes a family office successful? Taxations, succession rights, holdings, portfolios, diversification, and just having a balance sheet and a CEO and operating manager who will make sure that there is capital allocated for certain areas of investments, and then if not, you sell something. Where we want to be in my organization, we want to be advisors to them on a global basis. I write for Forbes and Wall Street Journal and Huffington Post every week, educating people on what's happening in the space. We're coming out with a publication called Family Offices Today, just focused on the family offices and their challenges. But we also look at, what are investment areas of interest that has been growing very steadily. Anything from luxury paintings, both modern and historical paintings from the Grand Masters, to different alternative asset investments. I'll let you know, for instance, in 2010 in the U.S., that was the first year where more people were going into retirement than entering the workforce. And for the next 40 years, the U.S. will face that challenge. Consequently, because of the great financial crisis, you now have all the pension funds having to look at alternative investments.
Looking for performance.
Right. And, the public stock has the allocation. Bonds are giving them hardly any return at all, and treasuries. So the next area for their focus over the next 30 years, according to us, is going to be real estate. People understand real estate.
It's going to be
real
what?
estate.
Real estate, yes.
It's going to be real estate. The returns are still in the 8 to 12% range. They were even higher before, right after the crisis. And they need to compensate for the low returns they've had in the past. So as an alternative asset, we see real estate that currently family offices have about 12% investments in, going to be one of the growing areas that we have focused on for the last 20 years, actually. And we work with the Carlyle, we work with the Fortress and Cerberus of the world on the private equity side in Abu Dhabi. And then we have the DuPonts, the Rockefellers, and the family offices around the world, like Chanel and Maybach, Mercedes, that we've been working with for a long time, that are listening to us and starting to see that, yes, there is a shift in the institutional pension fund world that must occur, and that will be real estate. And it's not going to be gateway cities. It's going to have to be secondary and tertiary markets because the competition in the big cities, it's too harsh.
Yes.
So we started seeing our family office relationship in Saudi Arabia 2 years ago, starting putting money into hard money lending companies in Chicago suburbs. And that's when we started realizing there's been enough education for family offices in the Middle East and abroad to realize that going after 10, 12, 13% IRR investment in secondary and tertiary markets has the advantage of less competition and better pricing. And that's, part of the advice and advisory work that we've been doing for the last decade.
Oh, and certainly this program has discussed with the founder of, I don't want to give the name here necessarily, although it's Asset Avenue, a real estate equity platform, which sounds like something along these lines, which offers those kinds of returns you've been describing, and that are reasonably safe, that a family office, if the the representations are accurate, a family office might be particularly interested in.
Unfortunately, they don't look at crowdfunding for real estate as anything serious. They scoff at it right now, and they just don't see it being scalable. We have a publication called Times Realty News, and we track 150 crowdfunding for real estate platforms globally. We started with writing an article in April 2013 about the top 10 in the world. Out of those 10, 6 weren't even operational. Then we wrote top 25 last April, and then a friend wrote top 50 because we had top 50 on the website. And now we know there's over 120. But out of the top 20, only they are actually conducting business and transactions. And 4 out of 5 of those transactions are debt funds, debt transactions. The hard money lending loans. Mainly construction firms, they're buying some land and they need to have an 18-month loan to construct the property and sell the property. So those notes are between $150,000 to $250,000. The 1 out of 5 that's in equity are relatively small. They're usually between a couple of $1 million at the most. Of course, there have been some larger, but it's only 3 or 4 companies in the world who's done larger deals than $10 million in equity. Asset Avenue has spoken at conferences, and so has Groundbreaker and Fundrise, which is to us the leading platform in the world for crowdfunding for real estate. But their deals are still extremely small. The promise is there to make it bigger, and most of them are going after angel investors through the angel investors training from the different accelerators. You know, Real Crowd and Groundbreakers and CrowdStreet and Fundrise, they go after the mass market. And in my numbers, there were 8.6 million accredited investors in the U.S. last year. And to give you some numbers, 750,000 of those accredited investors last year invested almost $24.9 billion as angel investors. That means there's a chase for another 7.9 million accredited investors out there.
That's right.
For the people listening, by the way, accredited investor means, according to the SEC law that goes back to the 80s, that you have $200,000 in salary the last 2 years and expected to have it this year, $300,000 if you're married, or a combined net worth for a married couple of $1 million, excluding your main home. And because of that, you know, chase online to go after them, we're going to find more and more of them. But they're still putting in $5,000 to $10,000 investments, and some platforms will take $100. It is for the Joe on the street to do it, but the operators of these platforms that you're referring to, some of them are lawyers, few of them are commercial real estate experts, and most of them are technology wizards. So, you know, combining SEC regulation and FINRA regulation with actual large commercial real estate transactions and raising capital at the same time, there's really only 1 or 2 companies in the world who's done that successfully. Prodigy Networks is probably one of the more successful ones who spoke at our conference just 4 days ago. And they raised money for the 3rd high-rise in a skyscraper in Manhattan using crowdfunding laws. But besides them, nobody's really broken $10 million.
Well, I guess maybe the angel investors who are active at the upper end of the current market we're describing may be conscious, or maybe they should be conscious, that once it gets bigger, it will ultimately should attract the attention of family offices who have a substantial amount of capital they could deploy. So maybe their best times are ahead of them for a while until they
maybe as they talk to me, they don't want to be in the limelight like these kids are with their platforms. They don't need to be in the limelight.
Yeah.
I have a family office who's done crowdfunding for 5 years, and they have placed $800 million, and they don't need money. They got plenty of money. They got $9 billion. $2 billion of that money is managed accounts. They have to put in 20% of their own money, and I've seen them take down $80 million cash equity investments in 48 hours.
Okay,
they're not going to enter the crowdfunding world. They don't need to. So what I'm trying to say is you have the crowdfunding world in real estate, and then you have the crowdfunding world in family offices, and they're probably never going to mix.
The twain shall not meet. Well, with our last segment here, I'd like to talk about something near and dear to my heart, because as an insolvency lawyer, I'll be involved in a case, one part or another, where a company wants to be sold in a bankruptcy, for example. And the key is to get the highest price so that the constituencies pay the maximum amount. Well, how do you get the highest price? Well, you have an auction. But things are better if somebody steps forward early, and usually often private equity these days, acts as a stalking horse bidder and sort of sets the market. And that has to be a company that's eagerly investing in this type of market, in this type of enterprise, and will probably compete with other bidders to pay the maximum price. Well, it's been my experience that there have been some family offices who were private in nature, but I got connected to them by folks in the know. Family offices that may have made their initial money in the particular industry that the bankrupt company was in, an industry they're familiar with. And in that situation, well, they can quickly pull together $55 million, maybe a lot faster than a larger private equity firm that has a board of directors or shareholders or committees within the firm that the active participants in the firm have to answer to. Do you believe that's a potential opportunity for family offices?
This was exactly the conversation I had yesterday in my offices on 3rd Avenue in Manhattan. The private equity professional who worked for a $20 billion family office asking me to get an opportunity to do so again with family offices. Prop funds, patch of land, and Crowd Alliance are other groups that we work with in crowdfunding. But specifically in family offices, Crowd Alliance is a family office who actually are entering the crowdfunding world, both on the property side of real estate as well as on the private equity side of real estate, of non-real estate deals. And their family office that actually can pull that off that you're referring to. And we've worked with several deals in bankruptcy court where we have family offices backing some fantastic deals, being able to bring the cash together extremely fast.
Yeah.
I would like to talk offline with you directly, specifically about those situations, because we have quite a few of these relationships. And, we have a family office network out of London called Victoria Partners, not to be confused with Victoria Global, which is a corporate communication company. Mm-hmm. The Victoria Partners is run by Martina Yanikova out of London, and we maintain relationships with 250 different family offices globally very closely. And we have access to another 1,000 of them. But it takes time to build relationships, and I spent 20 years building the relationships and not asking for capital unless it's a perfect fit. So over the decades, those relationships gives us a lot of social capital, and the information and access that you're telling me today is exactly what I know that they want to hear about, because I've seen some of these deals, and I even brought CEOs from luxury companies like Chopard and Cartier and Lalique to run new acquisitions through family offices in bankruptcy court. So we've had both on the acquisition side as well as the capital side, but also on the manpower side. Some of the turnaround companies that we worked with, like Alvarez Marsal, they used to do monthly dinners at my house, which was the original Soho Loft. It was actually a loft. Yeah. They took Hilfiger private, and once a month they would bring in GE Capital, Apex Capital, and tons of other groups like Cerberus Capital and Fortress Capital to my place, and they would actually talk about deals and line up 2-3 executives to be interim CEO should the acquisition in bankruptcy force the current CEO to leave or skip ship. So yes, we worked in that space for a long time, and it's a fascinating space, and the returns are tremendous if you get the right asset.
That has been my view as well. Well, Mr. Drake, it has been a fascinating half an hour. And we'd be happy to have you on again if the opportunity presents itself for both of us. And I want to thank you very much for your participation.
You're very kind, and I hope we get a chance to talk within the next couple of days privately.
Very well. This is Christopher Cahill, thanking you for listening and looking forward to getting together with you again next time.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.